This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. This episode is all about the risk and reward of decision making. Sometimes we avoid making decisions, and often we never even learn from our bad ones. I was fortunate when I became a trader that I was put in a situation where I had to make a lot of decisions frequently, sometimes dozens of decisions an hour about getting in or out of a trade. And it sort of taught me to leave the past behind, because once you made a decision, you couldn't go back. So now you just had to deal with moving forward. I also learned that from learning to fly an airplane when I was 15 years old. That ingrained in me, boy, indecision will kill you. So you have to make decisions, live with them, and then move on. So yeah, I was fortunate in that sense, having those two training backgrounds. And I actually wrote a book to my father. I may have told this story before. He taught me how to fly an airplane when I was 15, got my license when I was 16, and didn't want to become a pilot like he was. He was a commercial pilot for a big airline. Wanted to forge my own path, and so I became a trader, but I had to, just recently, maybe 5 years ago or so, I had to tell him how important it was. What he taught me when I was 15 actually became so foundational in my career as a trader and investor in terms of decision making and risk management and probability and thinking about contingencies. And so I wrote him this book. It was probably 30 pages or so, where I explained all that to him, how and connected what I learned from him as a pilot and how I transferred it to trading. I called it Flight Plan for Trading, and he loves that book. I hope I get to see it again. But that doesn't mean I'm a perfect decision maker either. I still make all the mistakes we all do. So today I'm going to ask you, did you ever wonder how great investors and traders make decisions that put them consistently ahead of their peers? So I don't put myself in the category of greatness as a trader or an investor, but I know a little bit about those who belong in that category because I've spent considerable time in the past 2 decades studying great short-term traders and great long-term investors. Now, in finance, you always have to be careful when talking about success to make sure you are not just highlighting the survivors. Since there's always a winner in most games, we have to make certain we are looking at credible degrees of success over time that go beyond mere randomness. When I studied short-term traders in the 1990s in the commodity and currency pits of Chicago, and I read about them in Jack Schwager's Market Wizards books, I came away with 6 pillars of behavior that seem to make all the difference over time and across markets. Here they are. Number 1, psychology. Not just an awareness of your biases and decision-making habits, but continuous process improvement. Because, our behavior is ingrained in our brain. It's in neural pathways. And so we have to figure out, are we running the same loops over and over again when we make new decisions? Number 2 would be probability. Without sound mechanics of situational risk and reward, it's way too easy for emotions and bias to take over. Number 3, systems. Not just a computer that spits out signals, but systems for everything from your research process to your performance evaluation. Number 4, risk management. You have to have written rules for capital allocation and preservation, and it's just crucial. Number 5, discipline, sort of speaks for itself, especially if you're making dozens of investing or trading decisions per day so that you can follow those rules. And the last one, consistency. Because if you can run all these processes for years and survive the vagaries of changing markets and seasons, then you'll end up a very successful trader and or investor. So what happens when a trader or investor doesn't try to master these principles and skills? Well, at worst, they lose all their money pretty quickly, and I've seen it happen hundreds of times. At best, they might get lucky and survive, but not for long. And in the middle is the majority of people who try short-term trading. They slowly watch their money bleed away a little every week, sometimes in bigger chunks. And now this would be true for someone just investing this would not be true if someone was just handing their money over, say, to an index fund at Vanguard, or having their money managed by a competent pro. We're talking about people who are actively controlling their fortune. So when I saw how hard it was to apply these principles in the chaos of markets, I looked to two different sciences to help explain it. Behavioral finance, spearheaded by Nobel Prize winner Daniel Kahneman, looked at human decision-making under uncertainty and risk with experiments to find out what do most people do in a given situation. I say these researchers study us from the outside in to explain behavior. And the neuroscientists, of course, study us from the inside out to explain our actions. After I read as much of the important research from both sciences as I could, I came up with a stunning conclusion, or so I thought. And that was, your brain wasn't made to trade. And it fit with what evolutionary biologists and anthropologists were teaching us about what kind of brains a few million years of fits and starts gave us. In other words, what happened in evolution to give us the brains that we have now, and how they work in all these different structures and functions and chemicals. So our brains definitely weren't made for staring at prices moving rapidly up and down and changing our wealth outlook before our eyes by the second. So why does this matter? Because most of us do exactly the wrong things, especially in short-term trading. We hold on to losing trades and we take profits too soon. This is the mathematical recipe for making your money go away over time. Because in short-term trading, the golden rule is cut your losses short and let your winners run. Cut your losses short and let your winners run. But most people do the exact opposite. They keep their losers and they take their profits too quickly. So we break the golden rule of trading and we end up breaking our bank accounts. And this is because people assume that we can make rational decisions about our money that are best for the long term, but that's a big assumption. Most of us are very irrational when it comes to everyday money risk decisions and long-term planning ones too. I covered much of this in my March 21st podcast of this year, Irrational Demands of Anchors, Pearls, and Procrastination. Well, back in 2004, when I came up with my thesis that your brain wasn't made to trade, I was pretty proud of it as an original idea. Then I remembered a book I had read in 1990 that probably helped me along this path of thinking. New World, New Mind by Robert Ornstein and Robert Ehrlich. The former a neuroscientist and the latter a biologist who was famous for some of his alarming calls about overpopulation back in the 70s and 80s. Their book proposed that the evolution of our brains and our ability to sense cataclysmic change that takes place over long periods of time is simply not going fast enough. In other words, the way our brains evolved, now we can't see what's happening with technology, and we don't often make good decisions about it. And I think that's pretty apparent. So they propose that the only thing that can make a difference is accelerated cultural evolution. Here's how one bright observer described the book. One of the more compelling points the authors make is that not only are politicians being elected and rewarded on the basis of short-term decisions that are by many measures intellectually, morally, and financially corrupt, but the so-called knowledge workers, the scientists, engineers, and others who should be blowing the whistle, are so specialized that there's a real lack of integrative knowledge. Okay? I think that's a great description, and that's why I wanted to read that to you. So can you think of some areas besides the obvious climate change debate where short-term thinking blinds us to long-term effects and changes? I think of education versus the entertainment machine. Busy parents are far too likely to let their kids have electronic gadgets, TVs, and phones to babysit them because mom and dad have to do stuff, or both parents work. Another big one would be the nuclear arms race, which seemed to be a problem that got put on ice in the 1990s. And now, with North Korea making waves this month, we feel that old question again. Could it really happen? This is one of the biggest examples that Ornstein and Ehrlich highlighted in their book, New World, New Mind. And I can't remember exactly how they framed the problem or their solution, other than new cultural and political institutions that move beyond warfare as a primary solution. But the first thing that comes to mind for me is that if some of us are more irrational than others, why do we sleep tight thinking we can prevent nuclear war when just about any very lucky idiot could get his hands on a missile? That's scary stuff. And we can't say for sure we figured out a good solution just because we've gone 60-some years without an incident. Our Stone Age brains can barely comprehend that kind of cataclysm. So it's much easier just not to think about it. But Ornstein and Ehrlich thought we should try anyway. If you think I have a solution, I don't. But I am an eternal optimist, and so when I come back, I'm going to share a book by another dynamic duo who 25 years later care about our fate and science just as much as Ehrlich and Ornstein. I'll also break down this week's big trading in immuno-oncology stocks like Kite, Blue, and JUNO and how I played them. I'll be back faster than you can spell immuno-oncology. Did you know the future is better than you think? That's actually the subtitle of a book called Abundance. In 2012, Peter Diamandis and Stephen Kotler wrote Abundance. And I'm holding a copy that they updated in 2014. But if you don't know who these guys are, Peter Diamandis, he was the guy who created the X Prize for private space rocketry, right? And among his friends, all who have their own different rocket and space projects, are Richard Branson, Jeff Bezos, Larry Page of Google, and who am I forgetting? Oh, Elon Musk. How could I forget Elon Musk? So, Peter's been involved with, government and private space projects for probably 30 years, probably ever since he was in college. And so he's just like the go-to coordinator for all this stuff and likes to bring exciting future-thinking entrepreneurs together. And then Stephen Kotler, he's not a psychologist, but he definitely ranks up there in terms of the research that he's done. He runs something called the Flow Genome Project, where he wants to study the psychology of flow. And one of the ways he's done this is he has a book, I can't think of the title now, but it's about extreme athletes, where he's like, he has studied and talked to, the guys that want to surf, 80-foot waves or, base jump or all kinds of crazy stuff because he wanted to get inside their psychology. How do these people think? Individuals who take extreme risks where they know a single wrong decision or move could end their life. How do they prepare mentally for that, and how do they dive into that stuff without being reckless? So Peter and Stephen are friends, and they've come together to write some great books. I read one last year called Bold, which is kind of a continuation of Abundance. And so, this is the optimist's handbook, so to speak, for, dealing with technology and change and economics. And they, in both books, in Bold is kind of a continuation of Abundance. They talk about exponential technologies. And so I'll just list those. Networks and sensors, obviously anything to do with semiconductors and chips that can track data. Artificial intelligence, going through here fast. Robotics, just flipping through here. And then a lot of things in medicine, obviously. Anything to do with biotechnology, which we're going to talk about in a moment. Digital manufacturing and infinite computing. So digital manufacturing, they're talking about 3D printing, and then infinite computing, going beyond AI, where computers can solve a lot of problems that we thought they couldn't with massive parallel architectures. And then nanomaterials, nanotechnology. So, these guys are immersed in advanced technologies and want to talk about them all day, and they want to bring entrepreneurs together to solve the world's problems and think that, hey, we can solve poverty and starvation and pollution and some of the bigger things, and maybe even the nuclear arms race. So I've read both of these books. I just want to read you a couple of things from. I'll start with the introduction here. I want to read this one paragraph. And this is, they updated the 2014 edition. This was updated for the 2014 edition. A historical perspective. These are turbulent times. A quick glance at the headlines is enough to set anybody on edge. And with the endless media stream that has lately become our lives, it's hard to get away from those headlines. Worse, evolution shaped the human brain to be acutely aware of all the potential dangers, and thus our news media and politicians focus on the grim to capture your mind share. As will be explored in later chapters, this dire combination has a profound impact on human perception. It literally shuts off our ability to take in good news. So this is, this picks up on what we talked about in the first part of the show here, where I went back to Ornstein and Ehrlich, talking about, we need a new mind for this new world. We've got a Stone Age brain trying to deal with lightning fast changes, and some things don't compute. And Diamandis and Kotler, are all too familiar with that, and they want to expand the conversation as the optimists that they are, and help us take in some of the good news. And so that's what abundance, I think that was part of their mission and their motivation, was getting people to see that the future is very wide open and a lot of things are possible. And they're also very aware of what gets in the way of seeing that and being able to act on it, and that would be our cognitive biases. I'm going to read here from page 29. One reason abundance remains hard to accept is because we live in an extraordinarily uncertain world, and decision-making in the face of uncertainty is never easy. In a perfectly rational world, when given a choice, we would assess the probability and the utility of all possible outcomes. I'm laughing because, who does that? And then combine these two to make our call. But humans rarely have all the facts. We can't possibly know all the outcomes. And even if we did, we have neither the temporal flexibility nor the neurological capacity to analyze all the data. Rather, our decisions are made based on limited, often unreliable information, and further hampered by internal limits, the brain's processing power, for one, and external limits, the time constraints under which we have to make our decision. So we have developed a subconscious strategy, a problem-solving aid for just such situations. We rely upon heuristics. And this goes back to one of my first podcasts. I talked about Daniel Kahneman and what he taught me from a distance through his books, and decision-making models and judgmental heuristics, which are just mental shortcuts. How do people think, and what decision-making habits do they fall into? Back to Diamandis and Kotler here. Heuristics are cognitive shortcuts, time-saving, energy-saving rules of thumb that allow us to simplify the decision-making process. They come in all flavors. In the study of visual perception, clarity is a heuristic used to help us judge distances. The more sharply an object is seen, the closer it appears. In the field of social psychology, heuristics show up when we assign probabilities, like evaluating the possibility that a Hollywood actor is a cocaine addict. To answer this question, the first thing the brain does is check its database for known Hollywood drug users. This is known as the availability heuristic. How available are examples for comparison? And our ease of access to this information becomes a significant portion of our foundation for assessment. Normally, this is not a bad way to go. Heuristics are an evolutionary solution to an ongoing problem. We have limited mental resources and sometimes need to make decisions quickly. As such, they have a very long and thoroughly time-tested history of helping us, on average, make better decisions. But what Kahneman discovered is that there are certain situations when our reliance on heuristics leads to what he calls severe and systematic errors. So we've talked about some of those, and I've definitely experienced most of them in my trading career. One thing I want to share with you is, how does this apply to more longer term investors? Some of the hedge fund managers that I follow, who when they take a position in an industry or a stock, it's because they have a view that goes out 3, 5, 10 years. And I follow many of those, and most of you are probably aware of Warren Buffett and his philosophy of investing, which is when he buys a company, how long does he want to own it? Forever. But his long term is longer than anyone's, though, so it's really hard to talk about him. But I'm going to share with you a great analysis of what the best investors do that the rest of us don't. Before I do, let's talk about what happened this week in biotechnology. Some really exciting stuff. And it very exciting for me because I've tried to be as on top of it as I can in the past few years. And more recently this year when I started a new portfolio here at Zacks called Healthcare Innovators, where I'm assembling a basket of stocks that I want to see if I can own for 3 to 5 years and capitalize on what I call the mega trends of healthcare investing, where we have an aging population of people who are living longer. So you're seeing more people in their 80s and 90s, but who will also need more care. So it just drives demand for new solutions from healthcare companies, whether it's a pharmaceutical company or a medical products or device company or new types of surgery and procedures. And so I've assembled a basket of over 25 stocks that cover all these different industries in healthcare to capitalize on some of these longer-term secular trends. Since I have sort of a penchant for biotech stocks too, there's quite a few in there. I own Gilead Pharmaceuticals, and they have a big war chest of cash, but the stock has been going nowhere because 6-7 years ago, they plunked down $11 billion to buy a company called Pharma, which gave them a new hepatitis C drug, and that vaulted Gilead's revenues. But they haven't been able to reproduce that. So every investor who watches Gilead says, hey, when are they going to make their next move with the $30 billion in cash they're sitting on? Well, they finally did it this week. They bought Kite Pharmaceuticals, and Kite was already having a terrific year. Kind of makes me wonder who on Wall Street knew this was coming. But the stock is up like 100% this year. Gilead came in and bought it for about $12 billion, $11.9 billion. They paid $180 a share, which was a 29% premium to where it had closed last week. And Kite specializes in an area of biotechnology that is called immuno-oncology, where researchers are discovering and hopefully teaching the immune system to fight cancer. Just an incredibly exciting area. And Kite is one of the forerunners there, and Gilead knew it, and so they went and bought this franchise, and hopefully they're going to turn it into something. I suspect they will, but there's a lot of unknowns still, about the science and what's achievable. But basically, one of the names that this particular type of immuno-oncology goes by is CAR-T, and CAR stands for chimeric antigen receptor, and the T is about your body's T cells, your warriors that fight disease. And researchers are able to extract T cells and then modify them, sort of re-engineer them so that they can communicate with proteins in the body in a new way. Because here's the problem. Here's the threat of cancer. Cancer is tricky. It fools the immune system, so the immune system can't even recognize it or see it. And so by re-engineering these proteins, researchers can make your immune system recognize the cancer in your body and then attack it, which is pretty cool. So I did not own Kite for the big pop that it had this week, but I did own two of its peers, and they were JUNO Therapeutics and Bluebird Bio. Both stocks have had a good week on the back of Kite getting bought because investors were thinking, hey, if somebody's going to buy Kite, that's one less breakthrough immuno-oncology stock out there, and now all that's left is Blue and JUNO. So JUNO launched the most, and it was one I owned. I'd been a big fan of it for a long time. I was telling people this year, buy it below $25. Buy it anytime it gets near 20. And today we actually took profits and sold it for nearly a 70% profit up above 40, which was really nice. But I got some emails from some folks who were thinking, hey, isn't this a long-term portfolio? Shouldn't we hang on to JUNO? Isn't it gonna end up with a valuation just like Kite? Remember I said Kite got taken out for $12 billion? Well, JUNO's valuation was $3 billion last week. Today it's $4 billion on its big rise higher. So won't it become a $10 billion stock? Let me read one of the emails that I got questioning my decision making here, since this is all about decision making. The person said, but if it's one of your stellar holdings, why did you sell? Pure profit? You're going to pick it back up at a later time? And so this person, she was trying to sort out, what was my decision making? Was I treating this as, is trading just short-term investing? Is that the way, did I invent something new called short-term investing, which is my style of trading for this portfolio? Or what was my long-term plan? So I had to explain. I had to, explain how did I make this decision to sell? And I already knew. So, but it's like everything is situational. Every risk-reward decision, especially with a given stock, is very situational. When you get down to the company-specific level, there's always unique and bigger risks than if you're just buying a basket of stocks or an ETF or a fund. So I said, good question. My original target for JUNO was $45 when I bought it near $25. And that was just based on what I thought it could do, that it could almost double. I said it would be a double from 20 easy. Now, what happened this morning that made the stock, JUNO jumped 20% higher yesterday and then another 15% today. So when you get 35% gains in 2 days, you get eager to take them, but it was coming up in my target. Now, part of the reason it jumped today was because two investment banks raised their 12-month price targets, one to $42 and one to $45. So that made everybody think, hey, this is really going there. So it moved from 36 up into the 40s very quickly this morning. Probably a lot of short covering from those ne'er-do-wells who thought the stock should go to $10 and were short too many shares, so they had to get out. And so they were doing some panic covering. But another investment bank was less optimistic because they don't see JUNO really as an acquisition trophy like Kite, because Celgene, another company I own, is comparable to Gilead, one of the big four horsemen of biotech, actually already owns over 10% of JUNO. And they have partner and royalty agreements. So the chances of JUNO being bought by anybody else were slim, and maybe Celgene wouldn't have to because they're already getting the milk for free, sort of. So they would still benefit if JUNO's clinical trials succeed, and that's the other. You always have risk with a biotech that, hey, if they could be in phase 2, but what if it doesn't work out? What if there's a problem? And JUNO already had a program they had to cancel this year due to safety. The FDA said, you got to shut that down. So to me, the risk reward was well priced in at $45 after we made 70% on the stock. So I decided to dance to the bank, and that's what we did. So sometimes I have to explain my decision making on individual stocks to my subscribers here, and we did that. All right, I talked about a few stocks I wanted to, just to round out the active trading discussion here and wrap it into to our larger discussion of how we make decisions with risk and reward. Now I want to share with you this article I told you about. It's a great blog, and the title of it is, What Do the Best Investors Do That the Rest Don't? This is written by Gary Mishuris just on August 27th on his blog, Behavioral Value Investor. And so I'm going to highlight a few of his key points here. He starts out, Charlie Munger, the vice chairman of Berkshire Hathaway and Warren Buffett's partner, said something simple yet profound at the 2017 Berkshire Hathaway annual meeting. A lot of other people are trying to be brilliant, and we are just trying to stay rational. And it's a big advantage. So that was the Charlie Munger quote. Some might think that becoming an excellent investor requires off-the-charts intelligence or some highly proprietary model that leads to an edge that nobody else can replicate. But that is not what experience has shown. Here are some traits and behaviors that have allowed investors to excel over the long term. Number 1, temperament. Temperament is the most important quality for an investor to have. My observation, and this is again Gary Mishuris writing, my observation of many investors over my 15 plus years of professional investing has led me to believe that temperament cannot be learned. but rather it is an innate characteristic of one's personality. Some people are able to remain rational and continue to follow their process even under great duress or during periods of extreme or periods of external upheaval. Others get swept up in the emotion that typically runs amok during such circumstances and abandon their discipline. Number 2, the ability to do nothing most of the time. Most of the time, there are a few good investments that combine sufficient business quality with a large margin of safety. And that's sort of the value investors' mantra, right? They want to, sufficient business quality with a large margin of safety, meaning they're buying the company cheaper than the intrinsic value that they think it's going to be worth on some kind of discounted cash flow basis. Oh, and that's where he goes on here. Margin of safety in the form of a large gap between price and intrinsic value. That doesn't mean that great investors are spending all of their time relaxing on the beach. To the contrary, they are typically avariciously reading and studying business and industries, preparing for the moment when securities of companies they understand well can be purchased at attractive prices. It does mean that they make investments infrequently, and that most of the time when they look at a potential opportunity, they end up passing. Those who are unable to maintain this state of low activity frequently end up making questionable investments to satisfy their desire to do something. And more often than not, it is their brokers who are the biggest beneficiaries of their elevated activity levels. The third trait that he thinks good long-term investors share is the accumulation of mental models. Understanding different disciplines helps great investors look at questions of business analysis in new ways. While studying economics and industry-specific information can certainly help, the best investors also use insights from other fields to reach better decisions. And now for me, I could think that would be, studying biology, how do biological systems work, studying other components of another industry that might give you insights about the industry you're specialized on. He goes on here. He's got 2 more points. Number 4 is focus on process over outcome. Yeah, that makes sense. Definitely in trading or investing, you have to have a process that you can repeat and can deliver solid results consistently over time, even if it has an occasional error or goof. And then number 5, minimizing behavioral biases, which we've talked about extensively. In closing here, he talks about, this is how he has an edge as an investor. Not secret market intel, just a process of approaching the market and of evaluating his own performance and staying humble with it. I'll in the article I connect to this podcast, I'll put a link to this blog from Gary Mashuris. So I hope we've covered some things that can help you think about the risk and reward in your own decision making, whether that's in investing or something crazy like base jumping or dealing with political tension in other parts of the world. And I look forward to discussing more of your favorite topics. So shoot me an email, find me on Twitter @KevinBCook. Let me know what you think, and let's hear where you want to go with a future that's better than you think. Thanks for joining me.